Welcome back to Orange U.S. Stock Research. Today, we are diving deep into one of the most talked about companies in the clean energy and artificial intelligence space, Oklo Inc., trading under the ticker symbol OKLO. If you have been following the massive energy demands driven by the AI revolution, you have likely heard this name. Oklo is an advanced nuclear technology company that went public in May 2024 through a SPAC merger with Altc Acquisition Corp., famously backed by OpenAI CEO Sam Altman, who also served as Oklo's board chairman for nearly a decade before stepping down in April 2025. In this video, we will break down Oklo's fundamentals, financials, competitive moat, growth potential, and the significant risks involved, before giving you our final score and investment view. Let us get started. Headquartered in Santa Clara, California, and founded by MIT graduates Jacob DeWitt and Caroline Cochran, Oklo is developing next-generation fast fission powerhouses to produce abundant, clean energy globally. Their flagship product is the Aurora Powerhouse, a small modular reactor designed to generate between 15 and 75 megawatts of electricity, scalable beyond 100 megawatts. Oklo is also pioneering advanced nuclear fuel recycling technologies, aiming to close the nuclear fuel cycle. This dual approach of generating power and recycling fuel makes them a highly unique player in the industry. Unlike traditional nuclear plants that take decades and billions of dollars to build, the Aurora is designed to be compact, modular, and deployable in remote locations. It uses a sodium-cooled fast reactor design with metal fuel and heat pipes, eliminating the need for complex water cooling systems. The Aurora Powerhouse has a design life of approximately 40 years, and can operate for up to 10 years without refueling. This makes it ideal for locations that need reliable, long-term power without constant maintenance. Currently, Oklo is a pre-revenue company. Their first commercial unit is under construction at the Idaho National Laboratory, having broken ground in September 2025. They have partnered with industry giants, selecting Kiewit Corporation as the lead constructor and signing a binding contract with Siemens Energy for the power conversion system. To understand Oklo's investment potential, we must first understand its unique business model. Oklo is not trying to win by selling reactor blueprints or heavy equipment to utility companies. Instead, they are building a utility-like model. Oklo intends to build, own, and operate the Aurora powerhouses themselves. Their revenue will come from selling the electricity and heat generated by these plants directly to end users through long-term power purchase agreements, or PPAs. This model shifts the massive upfront capital expenditure burden onto Oklo, but it promises a steady, recurring, and highly predictable revenue stream once the plants are operational. They are positioning themselves as a clean, independent power producer for the 21st century. By retaining ownership of the powerhouses, Oklo also maintains control over the entire life cycle, from construction and operation to eventual decommissioning and fuel recycling. Their target customers are entities with massive, continuous, and clean power requirements. This includes industrial sites, remote communities, and most importantly, data centers powering artificial intelligence. The AI boom has created an unprecedented demand for reliable, carbon-free baseload power. As of late 2025, the company had secured non-binding agreements for approximately 4,750 megawatts of power supply. That is the equivalent of several large-scale traditional nuclear power plants, all destined for data center customers. A significant growth catalyst was announced in January 2026, a massive agreement with Meta to develop a 1.2 gigawatt power campus in southern Ohio. Beyond Meta, Oklo also has prepayment agreements with data center giant Equinix. These hyperscaler partnerships validate Oklo's technology and business model. Looking at the critical milestones ahead, Oklo broke ground on its first Aurora powerhouse at the Idaho National Laboratory in September 2025. Pre-construction for the Meta campus in southern Ohio begins in 2026. The first phase of the Meta campus is targeted to come online by 2030, scaling to the full 1.2 gigawatts by 2034. The Meta agreement also includes a mechanism for Meta to prepay for power, advancing project certainty and providing Oklo with non-dilutive capital. If Oklo can successfully deploy its first Aurora powerhouse by late 2027 or early 2028, it will serve as a proof of concept that will likely unlock billions of dollars in future contracts. Moving to financials, it is crucial to reiterate that Oklo is currently in the pre-revenue stage. As of March 2026, you are investing in a vision and a pipeline, not current cash flows. Oklo currently commands a market capitalization of approximately $9.8 billion, with the stock price hovering around $62 per share. This represents a staggering 52-week change of over 160%, reflecting immense speculative premium and future expectations. Looking at the balance sheet, Oklo is in a very strong position to fund its near-term operations. As of the end of the third quarter of 2025, the company held over $920 million in total cash and equivalents. Remarkably, they have essentially zero debt, with total debt sitting at just $1.6 million, resulting in a debt-to-equity ratio of practically zero. However, the cash burn is significant and ongoing. The company's operating cash flow over the trailing 12 months was negative $62 million, and management has guided for an annual operating cash outflow of $65 million to $80 million. With a net income of negative $76 million and an earnings per share of negative 56 cents, profitability is still years away. This robust cash position is a direct result of their successful SPAC merger, and provides them with a vital runway to navigate the complex regulatory and construction phases. But investors must be aware that, at the current burn rate, even the $920 million cash pile will be significantly depleted before any meaningful revenue arrives. Valuation metrics are astronomical by traditional standards. The price-to-book ratio sits at over 8 times, having peaked at over 30 times in mid-2025. Because there is no revenue, price-to-earnings and price-to-sales ratios are not applicable. The enterprise value stands at $8.89 billion. Investors must understand that at these valuation levels, the market is pricing in flawless execution. Any misstep in their timeline or regulatory process will likely result in severe valuation compression. In the crowded and highly competitive space of small modular reactors, what is Oklo's economic moat? Why should they succeed over well-funded competitors like NuScale Power, Terra Power, or Kairos Power? Oklo's primary competitive advantage lies in its integrated approach to the nuclear fuel cycle, specifically its advanced fuel recycling technology. Oklo is not just building reactors. They are building the infrastructure to recycle spent nuclear fuel. In July 2024, they completed a successful end-to-end demonstration of this process, proving the viability of their technology. This capability is a massive differentiator. It addresses one of the most significant criticisms of nuclear power: nuclear waste. By turning spent fuel into a resource, Oklo provides itself with a proprietary and potentially much cheaper fuel source. The company estimates that commercial recycling could save up to 80% on fuel costs long-term. Furthermore, their strategic partnerships act as a secondary moat. Their planned joint venture with Centrus Energy to advance nuclear fuel services in Ohio solidifies their supply chain. Additionally, their historical ties to Sam Altman and the broader Silicon Valley ecosystem provide them with unparalleled access to capital and direct connections to the hyperscalers, who are the ultimate end customers for their power. The growth potential for Oklo is intrinsically linked to the explosive energy demands of the artificial intelligence industry. Data centers are transitioning from megawatt scale to gigawatt scale, and tech giants are desperately searching for reliable, 24/7 clean energy to power their massive server farms. Traditional renewable sources like wind and solar are intermittent and cannot meet this demand alone without massive battery storage. Nuclear energy, providing 24/7 power, is the missing puzzle piece. This is the fundamental tailwind driving Oklo's narrative. The total addressable market for clean baseload power is in the trillions, and Oklo is positioning itself at the very forefront of this nuclear renaissance. Despite the immense potential, investing in Oklo carries extreme risks that cannot be overstated. This is a high-risk, high-reward proposition. The first and most critical risk is regulatory approval. The nuclear industry is heavily regulated by the U.S. Nuclear Regulatory Commission, or NRC. Oklo's timeline for commercial operations in 2027 or 2028 is entirely dependent on receiving an NRC combined license. It is important to note that Oklo's initial application to the NRC in 2020 was denied due to information gaps. While they have revamped their approach, Regulatory delays are common in the nuclear sector and could severely impact their cash runway. The second major risk is execution and construction. Oklo has never built a commercial reactor. Transitioning from design to physical construction involves managing complex supply chains, navigating inflation, and ensuring rigorous safety standards. Delays and cost overruns are notorious in nuclear construction. Third is the milestone risk tied to their major customers. The prepayments from companies like Meta and Equinix come with strict conditions. If Oklo fails to reach critical development milestones by specific dates, such as July 2026, these prepayments could convert into debt. This would immediately transform Oklo's pristine balance sheet into a highly leveraged one, creating significant financial distress for a pre-revenue company. Fourth is the fuel supply risk. While their recycling technology is a powerful long-term moat, it is still in the developmental stage. In the near term, they rely on a constrained supply of recovered fuel and government approvals for fabrication. If the broader HALEU market faces bottlenecks, they will not be able to fuel their reactors. Finally, there is the valuation risk. At a nearly $10 billion market cap with zero revenue, the stock is priced for perfection. Any negative news regarding the NRC, construction delays, or the loss of a major customer contract could trigger a massive sell-off. Taking all these factors into consideration, it is time to assign an overall score to Oklo. We evaluate companies based on fundamentals, financial health, competitive advantage, growth prospects, and risk profile. For Oklo, the growth prospects are a perfect 20 out of 20, driven by the insatiable AI energy crisis and their massive pipeline. Their competitive moat, centered on proprietary fuel recycling and strong Silicon Valley ties, scores a solid 16 out of 20. Financial health scores 14 out of 20. While they have no revenue, their $920 million cash pile and zero debt provide a strong buffer. Fundamentals score 12 out of 20, reflecting the unproven nature of their commercial business model. Finally, the risk profile scores a low 8 out of 20 due to extreme regulatory hurdles, execution risks, and the potential for customer prepayments to convert to debt. This brings Oklo's total score to 70 out of 100. Our investment view: hold or wait and see. While the narrative is incredibly compelling and the partnerships with giants like Meta are highly validating, the current valuation of nearly $10 billion leaves absolutely no room for error. We believe Oklo is a revolutionary company that could define the future of energy, but the stock is currently too speculative for a core portfolio holding. We recommend keeping Oklo on a close watch list. Investors should wait for concrete progress on NRC licensing, successful construction milestones, or a significant pullback in valuation before initiating a position. This video represents personal opinions and analysis only, intended for informational and educational purposes. It does not constitute any investment advice, recommendation, or offer. Investing in the stock market involves significant risks, including the potential loss of principal. Always conduct your own thorough research and consult with a certified financial advisor before making any investment decisions. Thank you for watching Orange US Stock Research. Please like, subscribe, and leave your thoughts on Oklo in the comments below. See you in the next video.